Tonight on FactWire Report, a major AI partnership resets its funding playbook. Global markets digest fresh central bank signals, U.S. consumer sentiment eases, and Washington advances a trade measure with global ripple effects. Microsoft and OpenAI have agreed to a restructuring that removes long-standing fundraising constraints for the ChatGPT maker, positioning the company to raise significant outside capital and potentially pursue a public listing. Under the new setup, OpenAI operates as a public benefit corporation controlled by a nonprofit, while Microsoft remains a key strategic partner. The change is designed to give OpenAI more flexibility to finance the enormous computing and infrastructure needs that come with building next-generation AI systems. As part of the arrangement, Microsoft retains a 27% stake in OpenAI and continues to play a central role in the business relationship. The companies also outlined an independent review panel that would be responsible for validating any future claim that OpenAI has reached artificial general intelligence, a milestone that could alter elements of their revenue-sharing and product rights agreements. The intent is to create governance guardrails while preserving room for rapid product development and ecosystem growth. The deal also loosens prior restrictions around compute sourcing and hardware rights, giving OpenAI more freedom to secure resources while maintaining close collaboration with Microsoft. In parallel, OpenAI plans to accelerate its shift from a pure product company to a broader platform, enabling developers and enterprises to build customized tools atop its models. That approach aims to capture more of the value being created as organizations integrate generative AI across workflows, customer experience, and analytics. Financially, the restructuring signals ambitions that extend far beyond incremental feature launches. Executives framed the path as a necessary step to fund data center expansion and model training at unprecedented scale. Reporting around the announcement highlighted the sheer size of anticipated compute commitments over the coming years. If capital markets ultimately become part of the plan, an eventual IPO would give OpenAI direct access to public investors, while the nonprofit retains mission-oriented control. For Microsoft, the agreement keeps it deeply integrated into OpenAI's roadmap through the early 2030s, reinforcing Azure's position in AI workloads and aligning incentives as the technology matures. Finally, the companies emphasized user momentum as a foundation for these moves. With a broad base of weekly users and a growing developer community, OpenAI is seeking both durability and speed. Durability through governance that can credibly manage breakthrough claims, and speed through capital and compute flexibility to meet demand. The bottom line? The partnership evolves from a constrained structure into one built to scale, with clear checks on extraordinary milestones and a wider aperture for funding and platform growth. Following the restructuring news in AI, markets across Asia opened with a cautious lift. Up next, how rate expectations and big tech earnings are shaping sentiment from Tokyo to Seoul. Asian equities edged higher as investors latched on to fresh optimism around artificial intelligence while awaiting the Federal Reserve's policy decision and a heavy slate of technology earnings. A Reuters market note out of Singapore reported that momentum from Wall Street, bolstered by upbeat AI headlines, helped lift regional shares at the open. The backdrop includes ongoing enthusiasm for next-gen chips and platforms. Recent reporting highlighted NVIDIA's large bookings pipeline for AI processors and plans to build several new U.S. supercomputers, news that has kept the sector in focus, while Microsoft's agreement enabling OpenAI's restructuring added to the narrative that capital and compute are scaling in tandem. Together, these signals have supported risk appetite across global markets this week. By session time, MSCI's broad Asia-Pacific index outside Japan was modestly higher, with Japan's Nikkei jumping more than 1% to notch another record, and South Korea's Kospi also setting fresh highs. Gains were led by AI-linked names and select exporters, reflecting a view that demand for advanced compute will remain resilient into year-end. All of this plays out as investors position for the Fed. Markets have been pricing a 25 basis point cut, and attention is fixed on any guidance about a potential end to quantitative tightening, signals that would shape the path of yields and the dollar into December. The tone of the statement and the press conference will matter as much as the move itself. In early trading cues, futures pointed to a restrained tone in U.S. equities, while European contracts were mixed, underscoring that expectations are high from megacap results. The question for markets: can earnings and guidance show durable AI monetization beyond headline bookings and pilots? With valuations stretched in pockets of tech, investors are looking for proof points in revenue mix, capex payback, and workload growth. For Asia, currency and rate dynamics remain in focus as well. The yen's moves ahead of the Bank of Japan's decision and the Australian inflation surprise have kept policy paths under scrutiny. Still, the day's message was measured optimism. AI remains a tailwind, and the near-term direction hinges on the Fed's tone and what the largest platforms say about demand in the quarter ahead. With markets leaning on expectations and headlines, the real test is confidence at home. Next, a fresh read on U.S. consumer sentiment and what it signals for spending. U.S. consumer confidence softened slightly in October, offering a measured read on household sentiment heading into the year's final stretch. The Conference Board's headline Consumer Confidence Index edged down by 1 point to 94.6, from a revised 95.6 in September, continuing a sideways pattern rather than a sharp shift. Under the hood, the Present Situation Index improved to 129.3, while the Expectations Index slipped to 71.5, a level that historically signals caution when it stays below 80. Survey responses suggest price pressures remain the primary concern for many households. That aligns with recent data showing inflation running at a moderate but still noticeable pace, even as some categories, like shelter, have shown tentative cooling. The result is a nuanced picture. Consumers feel reasonably steady about current conditions, but are more reserved about the next 6 months, especially around income, business activity, and job prospects. Major newswires reinforce that narrative. October's reading marked a modest downtick and a 6-month low on some measures, with analysts noting that improved assessments of today's job market coexisted with softer expectations about tomorrow. Markets and policymakers will parse that split, firmer now, softer later, as they assess the path for rates, spending, and holiday season demand. For retailers and services firms, the takeaway is to expect thoughtful, value-oriented purchasing rather than broad-based exuberance. Durable goods intentions were little changed, home buying plans eased slightly on the month, and vehicle intentions ticked up, signals that consumers are selectively prioritizing big-ticket spending. Business leaders will watch whether November's data confirm this pattern, especially as promotional calendars ramp up. Big picture, confidence didn't break, it nudged lower. The improvement in the Present Situation Index hints at resilience, while the softer Expectations Index argues for prudence. As companies plan inventory, staffing, and pricing through year-end, this mix points to a steady but discerning demand and a premium on clear value, reliable availability, and helpful service. From household sentiment to trade policy, up next, a Senate vote aimed at unwinding select tariffs on Brazil and what it could mean for prices, supply chains, and diplomacy. The U.S. Senate has passed a bill that would terminate tariffs on Brazilian goods by ending a national emergency declaration used as their legal basis. The measure cleared the chamber 52 to 48, with a handful of Republicans joining Democrats, signaling rare bipartisan support on a high-profile trade action. The bill now moves to the House of Representatives, where leaders are expected to shelve it, setting up a potential stalemate between the chambers. Backers of the legislation argue that the tariff rollback could relieve some cost pressure on U.S. buyers of imported inputs and finished goods. They contend that the emergency designation, introduced earlier this year, has contributed to higher prices for selected imports and complicated supply chains that rely on Brazil as a source of commodities and manufactured products. Opponents caution that removing the duties could reduce leverage in broader trade negotiations and send mixed signals to partners watching Washington's approach to economic statecraft. Procedurally, the Senate vote is the first in a series of expected tariff-related maneuvers, with additional measures targeting other countries reportedly in the queue. But even as the upper chamber advances its preferences, the lower chamber's leadership has repeatedly blocked similar efforts, making immediate policy change unlikely. For companies, the practical takeaway is to continue planning under the current tariff regime while monitoring for any shift if House dynamics change or a compromise emerges in conference. From a market perspective, a clean repeal would likely ripple through sectors that import metals, industrial components, and consumer goods from Brazil. Any prospect of lower duties would factor into inventory decisions for the holiday and post-holiday quarters. But timing matters. Unless the House takes up and passes the bill and the president signs it, tariffs remain in place. Trade desks will watch for statements from committee chairs and the House calendar to gauge momentum. Diplomatically, the Senate action also sends a signal to Brasilia that a portion of Washington's lawmakers favors de-escalation on this trade front. Still, with the House expected to hold the line, businesses should assume status quo for now and stress test scenarios around price, margin, and sourcing. In short, the Senate took a notable step, but supply chain planning should stay conservative until the legislative path becomes clearer. That's all for today. From AI strategy and market moves to sentiment and trade policy, you're caught up on the signals shaping the week. Stay informed, stay connected, and see you tomorrow on FactWire Report.